Welcome back to the Deep Dive. Today, we're doing more than just looking at charts. We're really trying to dissect the institutional architecture behind price moves. Our mission is to get some actionable insight into smart money concepts, SMC, and also the inner circle trader stuff, ICT. We're going to be drilling down specifically on those critical turning points, the ones that really define the whole market structure.
That's absolutely right. Yeah, we're moving past, the simple idea of just support and resistance lines.
Right.
The goal here is really shifting your perspective, moving away from how a typical retail trader might see patterns to understanding the structural turning points that the big institutional players actually target. We call these the points de bascule, those crucial swing highs and swing lows. They tell you what the market's really intending to do.
Okay, so the core mission here sounds pretty complex. It's not just about spotting where a high or a low is, right? It's about understanding the why behind it, the institutional intent. Why does the market reverse precisely at this specific level and maybe not that one over there?
Well, it's because the large players, the smart money, they manipulate these exact key swing points. They need to harvest fuel, basically. Liquidity. Yeah, that's what they need for their major, sustained moves. So we're essentially trying to unpack the secret institutional playbook today, and it really starts with acknowledging the game itself. So if we start with the absolute core premise of SMC and ICT, it's really built on just accepting the market's nature, like really accepting it.
Okay.
The market isn't this democratic playing field. It's systematically manipulated. We're talking large institutions, banks, big funds.
Right.
And they are actively using the liquidity, which, and just to be clear, means those clusters of stop losses and pending orders.
Okay, where everyone's stops are sitting.
Precisely. They use that retail liquidity against the retail traders.
It sounds almost conspiratorial when you put it like that. But how do we really separate this structural manipulation from just, the normal dynamics you get when big volume moves the market? Isn't it just a consequence of big money moving?
Well, yes and no. It is a consequence of volume, definitely. But it's executed with extreme precision and, frankly, predatory intent.
Bam.
The movement isn't random guesswork. It's often algorithmic. It's very precise. And that leads to that crucial kind of brutal saying within this methodology. If you don't know where the liquidity is, you are the liquidity.
Oof. Okay.
Yeah. Every failed high you see, every obvious double bottom, every trend line that gets touched, these are often engineered points, temptation points, really.
Engineered how?
Designed to draw in retail orders, so the institutions can then fill their massive positions against them.
Wow. Okay, that makes a lot more sense when you lay it out that way. It means if we're treating these turning points like traditional support or resistance, we're basically walking right into their trap.
You got it.
We're setting our stop exactly where the institution needs to grab fuel.
Exactly. And look, this whole philosophy, it isn't entirely brand new. These concepts, they draw heavily on older, proven ideas. Specifically, the Wyckoff method, back from the 1930s.
Wyckoff, right. Accumulation and distribution.
Precisely. Wyckoff taught traders to read the tape, essentially, to look at the logical footprints the big players left on the charts during those accumulation phases at the bottom and distribution phases at the top.
So SMC and ICT are kind of modernizing Wyckoff's principles then. Can we draw direct lines between them?
Oh, absolutely. Think about Wyckoff's spring, that false break below a trading range designed to grab stops.
Yeah.
Or his up thrust, the false break above the range. That's exactly what we now call a liquidity sweep. The entire SMC-ICT methodology centers on finding these manipulation points. It's about understanding that dirty game played during accumulation and distribution. The rules we're discussing today, they're just the modern criteria for identifying those classic manipulation phases.
Okay, so to navigate this sophisticated manipulation, you obviously can't look at everything the market throws at you. That'd be overwhelming.
Totally overwhelming.
So the methodology suggests focusing really intensely on just a few core areas. What are those 5 central tenets, the focal points for understanding SMC?
Right. These are the building blocks, and they're all interconnected. First, you absolutely have to understand market structure. This defines the main trend and, crucially, the location of our points of bascule.
Okay, structure first.
Second, identifying fair value gaps, or FVGs. These tell us where the market's been inefficient, where it moved too fast.
Inefficiency. Got it.
Third, recognizing liquidity itself. Where's the fuel located? Above highs, below lows.
The actual stops and orders.
Yep. Fourth, pinpointing order blocks, or OBs. These are the specific zones where institutions likely initiated their positions.
Institutional entry zones.
And finally, number 5 is aligning everything with time and price. This helps establish a high probability daily bias, understanding when the market is likely to move. Okay, wow. That's basically our roadmap for this whole deep dive then. But let's start right at the beginning, like you said, the foundation for everything else, market structure, which is built entirely on those critical turning points, the swing highs and lows. The points to bascule. Yeah, market structure it's paramount. It really involves identifying that series of high points and low points that define which way the trend is going.
But here's the big challenge, especially for beginners. Figuring out which highs and lows actually matter. Which ones are the valid points to bascule.
Right, because there are lots of little ups and downs.
Exactly. And if you map your structure inaccurately using the wrong points, then every single decision you make after that, your bias, your entry point, it's all going to be low probability. Garbage in, garbage out, basically.
I've heard people talk about this focus on 3 candles. Is there like a simple rule of thumb for identifying a valid swing point? There is, yeah. It's a useful starting point. A valid swing high, which is a bearish point to bascule, is typically formed by a 3-candle sequence. The middle candle has a higher high than the candle immediately to its left and the candle immediately to its right.
Okay, high is right in the middle of 3.
Right. And similarly, a valid swing low, a bullish point to bascule, is when that middle candle has a lower low than the candles on either side of it.
Lowest point in the middle.
Exactly. These simple 3-candle points, they form the backbone of our analysis because that's where liquidity tends to cluster, just above those highs, just below those lows.
Okay, so once we identify those valid points, we define the overall structure by looking for consecutive breaks, right? Uptrend means higher highs, higher lows. Downtrend, lower lows, lower highs. But, I mean, price action is messy in reality. How do we filter out all the noise?
That's a great question. We filter the noise by differentiating the scale of the structure. We need to separate the external levels from the internal structure.
Okay, let's clarify those. External levels. You sometimes hear ERL, external range liquidity. What exactly are we talking about there?
So the ERL, that represents the major primary swing highs and swing lows, usually on a higher time frame chart. These are the absolute extremes that mark the beginning and the end of a really significant impulsive move.
Like the start and finish of a big trend leg.
Exactly. They are the main trend boundaries. Think of them like the highway. These are the ultimate magnets for price. Price generally wants to reach these external levels eventually.
Okay, the highway. And then you have the internal structure, or IRL, internal range liquidity.
Right. The IRL is basically all the noise inside the highway. It's the pullbacks, the corrections, the smaller ranges and zigzags that happen within that bigger, higher time frame trend.
So like the potholes and the temporary detours on the highway. Perfect analogy. Yeah, and here's a really critical rule for traders using SMC ICT. Generally speaking, you want to avoid aggressively trading these internal ranges until you get confirmation that the move you're seeing on the lower time frame actually aligns with the bigger, higher time frame trend. Why is that?
Because trading that internal structure against the main HTF bias, often you're just participating in the smaller liquidity grabs, the little sweeps that are actually just building fuel for the bigger move towards the ERL.
Ah, okay. So the market is basically just bouncing between liquidity pools. It uses the smaller stops within the internal range IRL to gather energy before making that bigger push toward the external range high or low ERL. The ERL boundary is the ultimate prize.
Precisely. Yeah, that's the target. Now, understanding these valid points of bascule is what allows us to pinpoint 2 really key moments in how price is delivered. The break of structure, BOS, and the change of character, CSG.
All right, let's break those down. The break of structure, or BOS, that confirms the trend is continuing, right?
Yes, exactly. If we're in a clear uptrend, for example, a BOS happens when price breaks decisively and closes above a previous major swing high, a previous point to bascule.
Okay.
That signals the dominant trend is healthy, institutional buying pressure is still strong, and the market's pushing forward. Same idea, but reversed for a downtrend breaking a swing low.
Got it. But the change of character, the CHOCH, that sounds like the exciting one. That's the reversal signal. Can you give us a clear, practical example of how a CHH actually happens? Because sometimes just defining it isn't enough.
Sure. Let's imagine a clear uptrend. We've identified a valid higher high and a valid higher low. These are our established point to bascule.
Okay, uptrend is confirmed.
Right. Then the market moves up again, but this time it fails to make a new higher high. It stalls out, maybe just below the previous high, or makes a slightly lower high.
Okay, it loses momentum.
Exactly. And then, instead of just pulling back nicely to form another higher low, which would continue the trend, it does something different. It aggressively breaks below the previous confirmed higher low, the one that was protecting the uptrend.
So it fails to make the new high, and then it violates the last low that should have held.
Precisely that. That aggressive break below the previous valid swing low is the COCH. It signals an immediate shift, a change in character, literally.
Okay.
What was support before, that higher low, has now failed, and that previous swing low often becomes the new target area, maybe resistance, for a potential short trade. It's what traditional traders just call a trend reversal, but we see it as a key institutional signal. It may be the start of distribution or accumulation.
And you mentioned there's a validity check for the COCH. It can't just be like a tiny little poke below the low.
That's absolutely essential, yeah, for a COCH to be considered valid and not just another tricky liquidity sweep trying to fake you out. The latest impulsive move, the one that actually causes the shift, needs to be substantial. A good rule of thumb is it should be at least half the size of the previous impulsive move in the original trend direction.
Okay, can you give numbers?
Sure. If the previous leg up in our uptrend example covered, say, 50 pips, then the move down that creates the CHOC, breaking that prior low, it should ideally be 25 pips or more. And crucially, it needs to close decisively below that prior low.
Why the close?
The close matters. It prevents you from getting caught or whipsawed by weak, maybe manipulated movements that don't actually have true institutional weight behind them. You need commitment below that level. Okay, so now we get the structure. We've mapped out our key turning points, the points de bascule. The next logical step is understanding why these points are so incredibly important.
And that comes back to liquidity, right? They're targets for the institutional playbook because that's where the liquidity is clustered.
Exactly. That's the whole reason they matter so much.
So let's just reemphasize the definition of liquidity in this context. It's not just, oh, there's a lot of volume trading here. It's specifically about concentrated stops and orders, isn't it?
Purely about location, yes. Liquidity, for our purposes, is simply where stop losses and pending entry orders are sitting. We look for buy-side liquidity, BSL, sitting just above clear highs.
Stops from short sellers, buy stop entries.
Correct. And sell-side liquidity, SSL, sitting just below clear lows.
Stops from long positions, sell stop entries.
Exactly. Now think about it from the institution's perspective. They need vast amounts of liquidity to fill their huge orders without causing the price to spike wildly against them.
Right. They can't just slam the market buy button for millions.
No way. If a big bank needs to buy, say, $500 million worth of EURUSD, they can't just hit buy. They need willing sellers available at the price they want. And how do they create those sellers? By deliberately pushing price down to trigger the stop losses of existing retail buyers. Those triggered stops become sell orders that the institution can buy into.
So that move, the one that takes out all the stops below a low, it's not an accident. It's not the market just finding support. It's a deliberate act of manipulation. We call that a liquidity sweep or a liquidity run, right?
It is the institutional acquisition phase. That's how they acquire their position.
Yeah.
They intentionally push price past those key retail levels, whether it's an obvious point de bascule, a clear double top or bottom, maybe a well-known trend line.
Yeah, the obvious places.
The obvious places. They push price there specifically to trigger those retail stops and pending orders. This engineered liquidity allows them to enter their massive positions at the most favorable prices for them. It's honestly like shaking a tree to make all the apples, the stops, fall right into their basket.
Okay, they shake the tree, grab the liquidity.
Yeah.
Then how do we know the real direction is confirmed? How do we know they're done acquiring and ready to move?
That's where displacement comes in. Displacement is the immediate and usually aggressive reaction after the sweep has occurred. It's typically a very big, energetic push through market structure. It shows speed, conviction, and it often leaves behind a footprint, a market inefficiency, which we call a fair value gap, FVG. We'll get to those.
So the displacement is the market showing its hand.
Exactly. It reveals the true intentions. Let's say a kilo gets swept, SSL taken, and then immediately after, price displaces aggressively upward. That strong upward move confirms the sell-side liquidity has been absorbed, the institutions have likely filled their buy orders, and now the market is free to continue its intended bullish move. Displacement confirms the continuation in the new direction post-sweep. Okay, that makes sense. Now, I want to talk about something that seems designed to trick people. Inducement. This sounds like a classic trap setup where retail traders jump in too early thinking the trend has already started. Inducement. Yes, this is crucial to understand. It is engineered liquidity. It's designed specifically to lure in those early, eager traders just before the real intended move actually happens.
How does it typically look on a chart? Okay, the classic example. You see a clear break of structure, BOS, say, to the upside. Price breaks a high. Then it makes the first minor pullback, just a little dip down.
Okay.
Retail traders, seeing the BOS and then the pullback, think, great, the trend is continuing, here's my entry. They buy on that pullback and, crucially, place their stop loss just below the low of that minor pullback.
Right. Seems logical.
It does. But smart money knows this. So what often happens next? Price dips down one more time, specifically to sweep the low of that first minor pullback. That's the inducement. It takes out the stops of those early buyers. Then, having grabbed that final bit of fuel, it moves quickly in the originally intended direction, maybe up to a higher order block or FVG before reversing or just continuing the trend.
Wow. So if you enter immediately on that very first little pullback after a BOS, you are likely providing the liquidity for the real move. You are the inducement. Very often, yes. That's why patience is key. If you see a structure break and then an immediate small pullback, you should probably pause. Take a breath. Because the market might just be setting up that inducement trap before it goes to the actual high probability entry zone, like a deeper order block or an FVG created by the initial break. Okay, wait for the inducement sweep. Don't be the inducement. Got it. This all leads perfectly into one of the most powerful, but also maybe counterintuitive concepts, the institutional funding candle, IFC. Can you explain how this massive manipulation actually shows up on the chart?
Right, the IFC, it really illustrates the cost of acquiring liquidity for these big players.
Yeah.
An IFC is typically a large-bodied candle that forms when institutions have to temporarily trade against their main intention.
Wait, they trade against themselves? How does that work? Okay, let's use an example. Say a bank needs to build a massive long position they want to buy. To get the best price and find enough sellers, they might first aggressively sell momentarily. This creates a huge, strong-looking bearish candle that sweeps below a significant low, taking out all that sell-side liquidity, SSL.
So they're intentionally entering.
Yeah.
Losing sell trades.
Temporarily, yes, that's the key. Their primary, much larger position is going to be long. But that initial aggressive selling move, it puts those smaller temporary sell positions underwater. They are in a drawdown, a temporary loss on those sells.
Okay.
But, and this is crucial, that temporary loss is the calculated cost of doing business. It's the price they pay to acquire the massive buy volume they need at the optimal prices from all the sell stops they just triggered below the low. The long shadow or wick, often seen on the bottom of that IFC candle, that represents the institutional drawdown, the cost which fueled the subsequent sustained move up in their actual intended direction.
That is fascinating. So the moment the market looks the absolute weakest, the most bearish, with that huge down candle, that might actually be the exact moment smart money is taking a calculated temporary loss to load up enormous buy positions for the real move higher.
Precisely. It completely flips the conventional idea of market sentiment on its head, doesn't it? Fear is induced right when they are accumulating.
It really does. Wow.
Okay, so market structure gives us the roadmap. Liquidity gives us the fuel. Now we need the specific locations, the high probability zones, points of interest, or POIs where we might actually look to execute a trade. Let's start with the order block.
Right, the order block. What makes an order block a high probability one? What distinguishes it from just, any random up or down candle before a move?
Good question. Order blocks are definitely critical price ranges where we assume institutional engagement began.
Huh.
Technically speaking, a bearish OB is the last up-close candle just before a strong, forceful, bearish down move.
Okay, last buy before the sell-off.
Right. And a bullish OB is the last down-close candle just before a powerful bullish up move.
Last sell before the rally.
Exactly. But the context is everything. A high probability OB needs to meet ideally two key criteria. First, it should occur just before a strong displacement move, that aggressive push we talked about, confirming intent.
Okay, displacement needed. Second, and this is arguably more important, the order block should ideally have already taken out liquidity. It should be preceded by a clear liquidity sweep.
Ah, okay. So if I spot what looks like an order block, but it hasn't actually swept any previous significant high or low, it's probably a lower probability setup because it's missing that signature, that footprint of institutional fuel acquisition.
That's generally the thinking, yes.
Right.
You're really looking for the OB that was responsible for the liquidity grab. That's often the true zone institutions will defend or revisit later to mitigate, to fill the rest of their orders, or add to their position. Okay, order blocks need displacement and a prior liquidity sweep. Got it. Next up, we have the fair value gap, FVG, often called an imbalance. This is where market inefficiency lives, right?
That's right. The FVG represents an area where price moves so quickly, so aggressively, that it left an imbalance between buyers and sellers. It's defined by a specific three-candle pattern.
3 candles again.
Yeah. You look for an expansive middle candle, a big one, and it leaves a literal gap between the high of the first candle's wick and the low of the third candle's wick for a bullish FVG, or vice versa for bearish.
Okay, a visible gap between candle 1 and candle 3 wick.
Exactly. This area is technically often called BICE, which stands for buy-side imbalance, sell-side inefficiency, or SISI for the opposite. Because the market generally dislikes inefficiency, it has a strong tendency to gravitate back towards these gaps to, well, to fill them or rebalance the price action within them.
Does the market usually fill the entire gap, or is there a more specific target within the FVG that we should focus on?
This is a nuance that can really increase precision. While sometimes the market will fill the entire FVG, very often it only needs to reach the 50% midpoint of the gap. This is often called the mean threshold or consequent encroachment.
Okay, the halfway point of the gap.
Right. So if you place your entry or maybe even your profit target at that 50% mark of the FVG rather than just the edge of it, you can often significantly improve your probability of getting filled or seeing the reaction you expect.
Interesting. And there's a secondary rule that goes with these gaps too, right? Something about inversion.
Yes, inversion. This happens when an FVG basically fails to do its job. If price, instead of reacting at the FVG, actually breaks decisively through it and closes on the other side.
Okay, it slices right through the gap.
Exactly. Then that gap is no longer considered a magnet for price to return to. Instead, the boundary of that FVG, the level that failed, often flips its role. It becomes a new potential support or resistance level, an inverted FVG. So you always have to watch if your key POI, like an FVG, is actually holding or if it's getting invalidated and potentially inverting.
Constant monitoring needed. Okay, finally, to help filter these potential entry points even further, we need to consider where in the overall price swing they occur. This brings in the concept of premium and discount zones.
Absolutely critical for risk management and probability. For this, we use the standard Fibonacci retracement tool. You draw it from the extreme swing low to the extreme swing high of the entire price leg or range you're analyzing.
Okay, fib the whole swing.
Yep. The 50% level of that swing is called the equilibrium. It's the fair value midpoint.
And what's the golden rule for using this tool in SMC?
The golden rule is really driven by simple logic and getting optimal pricing. If you're looking to buy, go long, you absolutely must look for your entry setup, your valid OB or FVG mitigation down in the discount zone. That's the area below the 50% equilibrium level.
Buy low, buy at a discount. Makes sense.
Exactly. Conversely, if you're looking to sell, go short, you must look for your entry setup up in the premium zone. That's the area above the 50% equilibrium.
Sell high, sell at a premium.
You got it.
So I imagine trying to trade against this rule, like buying way up in the premium zone or selling down in the discount, that probably leads to pretty poor risk to reward ratios, right? You're essentially paying too much or selling too cheap. Precisely. Think about it. If you buy way up above the 50% level, your potential profit up to the high of the swing is already reduced, and your logical stop loss below the swing low is miles away. It just doesn't make sense from a risk perspective. High probability trading demands that your chosen POI mitigation aligns perfectly within the appropriate premium or discount zone relative to the higher time frame swing you're trading within. Okay, context is everything. Premium for sells, discount for buys. All right, so we've built a structural map, we understand where the fuel liquidity is, and we've located the high probability entry zones, POIs. But actually, pulling the trigger, execution, that seems to be all about when and how we trade. SMC ICT puts huge emphasis on the idea that the market is algorithmically timed, making specific session times really crucial.
Take time. Yeah, time is like the invisible hand guiding the market sometimes.
We generally define the trading day as running from 18.000 EST, which is 6 p.m. New York time, to 18.00 EST the following day. That's a daily cycle. Okay, 6 p.m. to 6 p.m. EST.
Right. And within that 24-hour cycle, institutional activity isn't spread out evenly. It tends to cluster into specific, highly active windows. We call these kill zones.
Kill zones, okay. Which ones are the most important for spotting this institutional activity?
Well, we tend to focus on two primary ones. First is the London kill zone. This runs roughly from 1:30 a.m. to 4:30 a.m. Eastern Standard Time. This session is often where the initial manipulation for the day occurs. Manipulation like sweeping liquidity.
Exactly. Institutions are often targeting the liquidity that built up above the high and below the low of the prior Asian trading session. They sweep that liquidity during London to start establishing their main positions for the day.
Okay, London sets the trap. And then the New York session, that often plays a different role.
Yeah, often it does. The New York AM session, particularly the window between 9:00 a.m. and 10:30 a.m. EST, frequently serves as the distribution phase or continuation phase, meaning
if London successfully manipulated the Asian range, swept liquidity, and created a clear displacement move, then the New York session often provides either the final push in that direction or maybe a slight retrace back to a newly formed POI, like an OB or FVG created during London, before the main move continues or distributes. Understanding the typical function of each session, like, is it likely to be sweeping liquidity or continuing a move? That's really key.
Okay, timing matters.
Yeah.
Now, for successful execution, we constantly hear about top-down analysis. How does doing this actually prevent us from taking a trade that looks technically perfect on a lower time frame, but is ultimately flawed?
Top-down analysis is essential. It's all about ensuring alignment across different timescales. You must harmonize your trading bias across multiple time frames. Let's take an example.
Please.
Say the 4-hour chart is clearly undeniably bearish. Price is making lower lows, lower highs, and it looks like it's heading towards a major external range low.
Okay, big picture is down.
Right. Now you zoom down to the 1-minute chart, maybe during the New York session, and you spot what looks like a perfect bullish order block forming after a tiny sweep of an intraday low. It looks textbook perfect on the 1 minute.
To take the long trade, right?
Very tempting. But you absolutely must avoid taking that long trade. Why? Because the higher time frame HTF context, that 4-hour bearish trend, is pulling the price downwards with much greater force. That perfect 1-minute bullish OB, it's most likely just the market sweeping some minor internal liquidity before the dominant 4-hour bearish trend resumes its downward path. Never fight the high time frame bias.
Okay, so if the HTF is bearish, we should only be actively hunting for high probability bearish setups on the lower time frames, LTF, like the 15-minute or 1 minute. Even if a bullish setup looks visually perfect down there.
That is the discipline required, yes.
Yeah.
To really qualify a trade as high probability, you need a kind of confirmation checklist. You should aim for at least 2, preferably 3 or more confluences lining up.
What would be on that checklist? Okay, key things would be, is my trade aligned with a higher time frame bias? Check. Was there a clear liquidity sweep of a significant point of bascule, like a previous day's high-low or session high-low? Check. Did that sweep result in displacement, ideally creating an FVG? Check. Is the potential reentry point, the OB or FVG I'm watching, located in the correct premium or discount zone relative to the HTF swing? Check. So multiple factors need to align. Can you maybe outline the ideal SMC entry model that brings all these concepts together in sequence? Sure, the optimal entry model often follows this sequence of events. First, you look for manipulation. That means a liquidity sweep of a higher time frame point of bascule, like the Asian session high, gets taken out during London.
Yeah.
Okay, step 1, manipulation sweep.
You need to see displacement away from that swept level and ideally a change of character, CHOCH, on your lower execution time frame, say the 1-minute or 5-minute chart. The COCH confirms the internal structure has shifted in response to the HTF sweep displacement and LTF CHOCH.
That sequence gives you the signal to look for an entry. You wait for a retrace back to a newly formed high-probability POI, like a fresh order block or an FVG that was created during the displacement move within that new direction. Entry on retrace to a valid POI.
And crucially, that POI must be located in the correct premium or discount zone of the relevant HTF price swing. If all those pieces line up, you have a high probability setup.
Manipulation, displacement, THCH, retrace to POI and PD zone.
Yes.
Got it. This all sounds like it relies heavily on discipline and the mental game. Let's talk risk management and having fixed rules, especially for listeners maybe thinking about going from demo to live trading.
The mental shift is huge.
Yeah.
The absolute first rule when going live, have low expectations initially. You're not going to suddenly become consistently profitable overnight just because you're using real money.
Manage expectations.
Okay. Regarding risk management itself, maintain absolute non-negotiable fixed rules. For example, always aim for a minimum 2R trade. That means your potential reward should be at least twice your potential risk. If you're risking, say, 10 pips on a trade, your target must be at least 20 pips away.
Minimum 1 to 2 risk to reward. Yeah. What about daily loss limits? I know from experience that taking loss after loss can be emotionally devastating. Absolutely critical to protect your capital and your psychological well-being. Have a hard stop-loss rule for the day. For instance, stop trading completely for the day after 2 consecutive losses, period. Shut down the charts, walk away, 2 losses, and you're done.
Yes.
And similarly, on the winning side, consider this. If you achieve 1 successful high-quality win that meets your minimum RR criteria, maybe consider stopping trading for the day then, too. Stop after 1 win. Why?
To protect those profits, and more importantly, to prevent the emotional roller coaster that often follows a win overconfidence, wanting to trade more, maybe giving back the profits, what traders call going on tilt. Banking a solid win and walking away builds discipline.
Okay, protect capital, protect psychology. What about dealing with your own bias? If I spend an hour analyzing a chart and I become convinced it has to go up, how do I avoid just forcing that view onto the market?
Objectivity is paramount. You cannot get emotionally attached to your analysis or stuck in a rigid daily bias. The second the market clearly invalidates your expected level, say, it breaks through your key POI and closes beyond it, you must be willing to accept the trade idea was wrong, take the loss if you are in, and immediately reassess. Be willing to flip sides if the price action is now clearly indicating it's moving towards the next logical opposing POI. Successful SMC traders are ruthlessly objective, not ideological about direction.
Be objective. Be ready to flip the bias. Got it.
Yeah.
Finally, let's talk about protecting profits within a winning trade. You mentioned earlier that trimming positions, taking partial profits, is often better than just slamming your stop loss to break even immediately. Why is that?
Yeah, moving your stop to break even too quickly is a common mistake. Why? Because the market rarely moves in a straight line. You'll often get small, sometimes aggressive, retracements or noise before the true continuation happens. Moving to BE too soon often means you get stopped out on that noise, only to watch the trade, then go to your original target without you. It's incredibly frustrating.
Okay, so what's the alternative? Trimming. Trimming or taking partials is often superior. Here's a common approach. If the price is moved, say 1R, 1 times your initial risk, in your favor, consider taking maybe 30% or 50% of your position off the table right there. Bank some profit. Exactly. This does 2 things. 1, it secures actual money in your account, which feels good and builds confidence. 2, it significantly reduces your risk on the remaining portion of the position. You can then often leave the stop on the remaining part at its original location, or trail it more loosely, giving the trade more breathing room to navigate any pullbacks and potentially run to the ultimate target, like the external range liquidity level, without getting prematurely stopped out. Secure profit, reduce risk, let the rest run. Makes a lot of sense. #tag outro.
Well, we've certainly covered a lot of ground today, a pretty massive deep dive, really. To summarize, I think the key takeaway is that trading using SMC and ICT principles is about fundamentally shifting your viewpoint. Okay. Moving away from just retail pattern recognition towards understanding institutional intent. It means focusing squarely on where the institutions are likely targeting liquidity, especially around those critical structural turning points, the point of the best skill. We've touched on the roadmap, that's market structure, the fuel, liquidity and sweeps, the specific entry zones, order blocks, and FVGs, and of course, the vital importance of timing and disciplined risk management.
Absolutely. So here's a final provocative thought for you, our listener, to maybe chew on, something that ties right back into that institutional psychology we've been discussing.
Okay.
Since you now understand that institutions often use manipulation suites to acquire their large positions, and that this process can involve creating things like the institutional funding candle, that moment where smart money intentionally takes a temporary loss or drawdown to generate the fuel they need.
Right, the cost of doing business for them.
Exactly. How will understanding that institutional cost of business change the way you personally view the fear of temporary drawdowns, or even taking necessary calculated losses in your own trading?
That's a powerful question. Because if you start seeing that institutional drawdown not as failure, but as necessary fuel, maybe you can start viewing your own small, well-managed losses not as mistakes, but simply as the required cost of putting yourself in a position to potentially catch the right trade. That's the difference, isn't it, between being the liquidity and trying to trade alongside the smart money.
Something to definitely think about. Thank you for joining us for this deep dive into points of best skill and liquidity. We'll see you next time.